Alright, so wanted to make a quick video ranking the most common trading indicators. This is purely my take based on my trading experience. Don't get offended if one of your favorite indicators gets into C or D. Just because I don't like them does not mean that they don't work, just means that my trading style and my experience did not lead me to using this indicator effectively. Maybe you do find a way how to use it effectively and actually make profit. Good for you. Different indicators fit different trading styles, so if it works for you, that's great. That being said, I'm not going to take into account price action and support and resistance levels, just because I think I don't count those as indicators. I count this as a foundation. So almost everyone I know uses that. Not to say that all of the traders use price action and support and resistance levels, but that's kind of like the basics, the foundation, and then indicators is something you just add to your chart on top of that. So let's get started. First thing first, let's go with Bollinger Bands. Bollinger Bands, I'm just going to put them into C for now. That will change depending on the other indicators, and as we go, I might just swap them and just move it higher or lower depending on the other indicators, and as you add them, you kind of compare them to the previous indicators. So Bollinger Bands is C. I feel like these are good for reversals, but with any indicator, it's never you get a signal and immediately you just go long or short. Obviously, you look at the bigger picture, at the context, at the price action. But with Bollinger Bands, I just feel like they give way too many fake signals where you don't need that. They're just, maybe if you play around with the settings, they'll be good. But based on my experience, I don't like Bollinger Bands. I would not recommend them. If it works for you, then that's great. Moving averages goes into C. I usually don't trade based off of the moving averages on their own. I do understand that people use them for golden crosses, the death crosses, and so on and so forth. For me personally, I like to fade the price as it touches the level. So if it would come from below, I would just short here. But then again, it depends on the context, on the price action. And then same with if it goes above, then I would just go long and so on and so forth. What I do like more than just a moving average, just one, I would say 2+ moving averages is always better, just because it gives you clearer context, better picture, better understanding of what's happening. So 2 or more moving averages, they get an A rating, while a single moving averages is good. It's a solid indicator, but it's a B because it's nothing special. It's not that amazing. MACD is pretty much same as Bollinger Bands. It's a very traditional indicator. I see a lot of people who started trading in the 80s or 90s, and they use MACD, and also a lot of people, a lot of newcomers, people who just started trading like a month or 2 months ago, they use MACD purely based on moving averages. I think a lot of these are, but MACD is basically moving averages based indicator, and it's essentially if it goes red, it's kind of indicating the weakness, and then if it goes green right here, then it's indicating that there is possible strength. I don't think it's as simple as just go short when it's red and then go long once it turns green, but a lot of people for some reason use it that way. Not sure why. I don't think it's very effective. Overall, I don't think it presents a better picture than, let's say, 2 or 3 moving averages. I think that they're just cleaner, easier to read than just this whole shebang. So MACD gets a C rating from me. Same with RSI. Actually, no, RSI I'm going to put right here just because, based on my experience, again, I understand that the video is subjective, that's why it's my tier list, but based on my experience, if you use higher time frames, so let's say daily or weekly, once it goes above the 70 mark or below the 30, it is generally a good area for longer term swings. So if it goes above, just fade it back short and sell, and then if it goes lower than 30, then probably it's a good area to buy or to go long. But just like with any other indicators, always use bigger picture, always look at the context. It's not as simple, but RSI, I feel like on higher time frames does give better signals than MACD or, let's say, Bollinger Bands for reversing for sure. Next one is VWAP. Personally, that one is going to go in front of the 2 or more moving averages. VWAP on its own is pretty good indicator. I use it for my mean reversion trades. So essentially, once we go to it, you could always try to long. And then if we come there from below, it's a good place for a short as well. The thing that's with the VWAP, it can become a significantly better indicator on its own, just the line itself. It's not an S class, but VWAP with standard deviation bands, I would put that in an S class. That's an excellent indicator. I use this all the time. It's amazing. And the way you use it is not just simply, oh, once it goes down into the blue bands or however you want to color them, if you want to color them red or green or whatever, you don't just buy just mindlessly, oh, just because it's in the blue I buy right away. Same with red, right? You don't just short just because it's there. But in general, more likely than not, if it's in the blue, the price is overextended to the downside, and then if it's in the red band, it's probably overextended to the upside, and you do want to sell here, you do want to buy here. But again, it depends on the context, because if we're in a trend, if we broke a major high time frame level here and we're in a downtrend, it's just going to keep on going deeper in the blue. And if you're going to keep buying without taking profit at the orange VWAP itself, or if you're just buying, let's say here, it's not going to go to the VWAP before taking you to the depths of hell. So watch out for that. It's an excellent indicator, but just like the others. I know I keep repeating that through the video. I hope people understand why, because I've seen so many other traders just use them just based on, oh, it's in blue, let's buy, or it's in red, time to sell. So just be wary of that. Other than that, it's a great indicator. I absolutely love VWAP bands. Perfect, just S from me. And then next one is depth of market, DOM, the ladder. I would put this in a B, just before RSI. So this is not useful for swing traders or higher time frame traders at all. This is purely for scalpers. And I feel like I've used it before. I feel like it's a good indicator. I'm not a scalper myself, so for me it's not that useful. And then if you're a scalper, then I would probably move it higher to maybe A, somewhere right, maybe in front of VWAP. I don't know, but it would be an A if you're a scalper. But for me, it's going to be B. I don't really use it, though I do recognize that it's a useful indicator. You're basically looking at the liquidity and the pulling up orders. The problem is with spoofing, but I think with time, again, with screen time, with experience, you recognize that where the movement is going to come from. So pretty good indicator. Some people call it just DOM. Some people say the full name, depth of market ladder. It's if you're a scalper, definitely give it a try. Next one is, again, it's a more of a scalper tool in my opinion, cumulative volume delta, the CVD. I've used it as well several times when I tried to do scalping. My story with scalping is basically I found it okay, but it was a little bit too fast-paced for my liking. I didn't like the idea of always being in a trade, always jumping back and forth between the trades. I'm more of a sort of a patient type of trader where I would just wait for an intraday swing opportunity or an overnight trade. So for me, cumulative volume delta is not useful at this point. So I'm gonna leave cumulative volume delta in B. Otherwise, I would move it to A if you were the scalper. Next one is TPO, market profiles, and they're useful for scalpers again, primarily. Still useful if you were an intraday trader, but I just feel like the next indicator after it, volume profile, is just so much better than TPO for me personally, because this one essentially shows time. So the amount of time that price spent somewhere at a certain price level, it shows as a cluster, versus volume profile that shows the actual volume as a cluster. So this one is based on time, this one is based on volume, and I just feel like volume profile is my top two favorite indicators. This goes into the category S, superior, whatever it stands for. So volume profile, definitely S, definitely better version of TPO, more advanced. I think TPO was invented in like 70s or 80s, and then volume profile was a later invention. Could be the same guy, I don't know if it's Dalton, I don't remember. But I feel like it's a more advanced TPO. It's a better TPO, and volume profile, you could use it for lower time frames, you could use it for higher time frames, and it's just so good at checking your support and resistance levels, identifying the gaps, the low volume nodes, and seeing the high volume nodes, the clusters. So TPO is still good. A lot of people who scalp, I see them use these. I personally just don't like them as much. I don't understand why I'd use that. If you know, actually drop it in the comments. Just interested on why would you ever use TPO if you have access to volume profiles. And then one thing I think maybe that comes to mind is that if TPO is showing one kind of a distribution and then volume profile is showing completely different distribution for the same time period, then maybe it's a sign that something is cooking, something is being cooked, and you need to watch out. So maybe is an sort of an alert signal. But then other than that, I would just put it in B. It's just not that good compared to volume profile, and volume profile stays in S along with VWAP bands. Actually, I would put it, if I had to choose one of these, I would probably still go for volume profile. Even though as you learn with screen time, you identify the supply demand zones, the support and resistance levels, pretty much without the volume profile, just looking at the price, looking at the chart. A lot of times it's those exact high volume nodes still. I feel like it's always good to sort of check yourself. So volume profile, I would put it as number one. Next one, Heatmaps. So Heatmaps, the most popular one I think is Bookmap. These are, I don't think they're that useful. Again, I know I'm repeating myself. Probably more useful if you're a scalper. I don't see that many scalper use this compared to like depth of market or CVD or TPO, but some do. And the ones that do, they're usually very, very happy with it. I tried it as well. I tried it on lower time frames, I tried it on higher time frames, and it was just basically showing me what I could see just looking at the chart with the support and resistance levels, and or looking in the volume profile. So I didn't see any need for it, and I don't think it's that good. Though I do understand that for some people it's just easier to look at the representation, the visual representation, instead of just looking at the numbers. So maybe it's a nicer picture for them to look at. Maybe that makes sense. But heat maps, I would put it in B. And let's move on to footprints. Footprints is another order flow tool, and unlike the others, yeah, obviously it's much more useful for scalpers, but I just feel like it's such a great indicator. I would still put it in A. I don't use it on a daily basis. I do think there is a lot of value in footprints if you're looking at absorption, exhaustion. Some people look at the imbalances as well. There are different type of footprints. You have delta footprints, you have volume footprints. You can look at it as an absorption versus exhaustion, the imbalance stuff that I mentioned earlier. There is definitely some use. One mistake I see people doing with footprints is when they use them on a daily time frame or any time frame higher than 30 minutes or 1 hour. It's just insane. Shouldn't do that. And then another mistake is when they do use it for a lower time frame, which is good, but they just look at it all the time at every single candle. You're supposed to look at footprints once it's approaching a zone, whether it's a support resistance level or whether it's one of the clusters that you identify using the market profile or the volume profile. And that's the area where you turn on the footprints and you look at the footprints at that exact area, trying to identify some kind of imbalance or if absorption, exhaustion is happening. So even though I do think it's more useful for scalpers than intraday or swing traders, it's still just such a good tool, such a neat indicator that I would just put it in A, just out of pure, I don't know, respect. So let's go with that. Footprints go into A. Next one is time and sales. I feel like that one is gonna go into B or C. B or C, B or C. Let's put it in B for now. And the reason why it's in B, it's not terrible, but it's not great. And it does work. I've seen people use time and sales, the orders coming in, and look at it and kind of get an idea of the momentum, where the market is moving, if we're shifting to the long side bias, if we're shifting to the short bias. But I feel like footprints, they're just superior in doing the same job. If you're trading ticks and if you're 1 second scalper, maybe time and sales is more important. But feel like footprints show pretty much the same information, but just they offer better presentation of the data. So I would say footprints trump the time and sales, and then time and sales, in my mind at least, this is how I see you're trying to be the guy from Rain Man counting cards, or I think it was toothpicks. So some insane amount of numbers, you just have to train your eye and just look at it, and you kind of, after some time, you understand if where the market is shifting or what's happening with the momentum. So I just think it's unnecessarily complex. So a lot of effort and pretty much same result that you can achieve with footprints. So why would you use it? That's my take on it. Another one is, I've seen this one a lot with the crypto traders, just people who trade crypto. They're like just pure perpetual futures crypto traders. They look at the open interest funding and whatnot. Like they come up with a bunch of like 4 or 5 indicators on one chart. And the problem with this, if you're just looking at open interest and you're saying, or funding, and you're saying funding is high, hence go long or go short, that's stupid. All right, that's a very bad idea. You need to use it. You need to use these in conjunction with each other. And again, what I said previously, understanding the bigger picture, understanding the context, looking at the price action, at everything else, footprints, whatever, and kind of, making a decision based off of that. But on their own, they're not that useful. You just have to look at many different indicators: the open interest, the funding, the this, that. I think they also have net longs, net shorts. I just kind of put it as a mix of crypto indicators right in here. All those fancy ones, they're just not that useful. I think they create a lot of noise, and they take your attention away from looking at the price action, the levels, and then these indicators right here. They're just simple. They're just easier to use. So a lot of this is also based on a lot of the rankings. They're based not on just how effective they are, but also on how simple it is to learn these indicators, how easy they are to use, because this is a great indicator. It's just much harder to learn than, let's say, VWAP or several moving averages. Same with time and sales. Same with open interest, funding, net longs, net shorts. All that cluster is just overkill, in my opinion. I don't think you need this for success. I don't think this is the secret, key to being profitable. Although none of these are, but certainly some of these, according to me, they are more helpful in your trading journey. So I would just concentrate on these instead of going into overly complex, this open interest, funding, net shorts, net longs kind of idea. Don't really like it. Next one is Gann. I've seen some people use it on Twitter. They call it X now. I like Twitter better. It's just a better name. X just sounds like something else. I have no doubt that there are probably some people who are using this and they're profitable in the trading. I try to use it. I tried to use every single indicator. I spent maybe a good couple of days on this back in 2021. And even if you get an idea of how to use it, it's just such a delicate type of, projection or whatever. People call it, it's a mathematical model or whatever. I just think it's so delicate that it's very easy to make a mistake. And then once you make a mistake, the whole idea is just off, and you're just way off. And it's just better to stick to regular support and resistance levels. This is another overkill. So maybe you're a Gann trader who is profitable. Good for you. I just feel like it's not that easy. And even if you learn it, even if you get a hang of it, even if it works, I'm not sure it works, but let's say it works, it's just so delicate, so easy to just use this as an inflection point or use that as an inflection point, and then it just doesn't work. It just gives you a huge margin of error, so not very reliable in my opinion. Elliott Waves, same thing really. Same thing. Overly complex, really easy to make a mistake and count wave 2 as ending here versus that, or where do you even start the wave count? There are obviously rules where they say, you have to do this, you have to look at A and then B and then C, and only then you can count it as wave 1 and so on and so forth. But I feel like it's just a lot of effort for the result that's not as reliable. So for me, it's just overly complex, very delicate as well, in a sense that it has a huge margin of error. So putting this in D, not great. Heikin Ashi. I know Heikin Ashi is not strictly speaking an indicator, it's more of a candlestick type, but I feel like a lot of people look at this as an indicator, so I wanted to include this as well. I tried Heikin Ashi, just like every single indicator here. I think it's alright. I think it's not terrible. it does give you sort of, it sort of evens out the price action noise, and you get a better idea, better understanding of the direction of the trend. But I don't think it's that good. The reason why I'm putting in B and not C is just because it's so easy to learn and so easy to use, so easy to look at, but it's not great. I wouldn't put it in A or S, and I don't use it myself. That being said, if you're a directional trader, or even if you're a longer term swing trader, probably useful for you. I don't know how if scalpers use this. I've never seen a scalper use this. Maybe there are some people who do, but I would put in B. Like, B is not terrible, but also not great. So it's just alright. And then another one would be Ichimoku. Ichimoku is, I would put it in B as well. It's great to use if you're intraday, great to use if you're a higher time frame trader, if you're a swing trader. Essentially a bunch of moving averages. I think Japanese invented it in like 1950s or 60s. I don't remember. There's like a whole book dedicated to just Ichimoku, and I spent a good amount of time learning it and kind of coming up with different trading strategies with Ichimoku. And it's all right. It's not bad at all. I just feel like, again, you could trade with this, you could be profitable, but it's just overly complex. Just a lot of times there is a lot of stuff going on at the same time, and you could get the same results with just adding 2 moving averages. And oh, I think I didn't say why I rank 2 or more moving averages over 1 moving average, and the reason for that is that if you're looking at, say, 200 daily, it doesn't matter if it's SMA or EMA. If you're looking at a 200 daily moving average, and then you also add the 50 or 100, you just have a better idea, better understanding, and you get a clearer picture of what's happening with the price versus if you just have one. And then coming back to Ichimoku, I even tried using like turning off some of the moving averages and just using 2 or 3, and there are like different strategies. But again, it's just an overkill. You can just use this and you just get better idea of what's happening. So gonna put it in B. It's pretty good. Again, not great. Volume, and this is not volume profile, this is volume at the bottom of your trading chart, the actual like volume by time. I know some people called it actually volume by price. I was very confused when I was starting out, and people would call it volume profile, and then others would just say volume by price. That was confusing, but this is the regular volume. You know, sort of, you get an hourly candle right here, and then you get the volume bar as well. I feel like I'm gonna put this in A. I use it myself from time to time. Again, I don't use it on a daily basis, but I do use this. I feel like it has value for scalpers. It brings value as well for intraday, for swing traders, for even long-term investors. I think looking at volume is very, very telling, and I feel like it gives you a lot of idea of what's happening in the market. So volume goes into A, and then last one is Fibonacci. Oh man, Fibonacci, that goes into a lot of people. Again, I've seen have success and they love Fibonacci, but I just feel like this goes into C. It's not that great. I just feel like it's do I want to put it in D? No, it's C. It's not that terrible. It doesn't have such a huge margin of error like Elliott and the Gann, but it's not great. I wouldn't recommend it. Just personally don't like it. And then maybe I'll put RSI in C as well, because I have way too many indicators in B. So that's that. So this is my tier list for the most popular indicators. Obviously there are way more indicators out there, like Keltner channels and, you know, proprietary indicators, but I just wanted to cover the most popular ones, the ones that I see most of the time, and kind of give you guys an idea of how I look at these indicators, how I rank them based on my experience and my trading style. Let me know in the comments if you agree, disagree, if you have any other indicators you would want me to do a tier list on. Maybe I'll do a second version with other additional indicators. And then if you disagree, I would appreciate it if you could add a comment saying why, and let's say you disagree with me saying that Fibonacci retracements are not that useful and just overly complex. Well, they're not complex, they're just not that useful. Just write out maybe 1 or 2 sentences explaining why. I would appreciate that. Always interested in learning more, in finding out what other people think about trading in general and then indicators in this case. So let me know in the comments. Thank you very much for watching the video.